All right, DPW. So this is a holding company that holds defense and tech companies. And so the newsflash today, DPW, one of their holdings, Gresham Worldwide, which is a defense company, got you know a few $1,000,000 for defense contracting. And so DPW holds Gresham Worldwide, and their subsidiary Microphase got contracts for 3.2, which is about enough contracts for a year or so of defense contracting. And so this is a big news blast. And here's just a look at DPW. So, I mean, they have older tech companies and older defense contracting companies, and they buy companies that they think they can improve the management of. And so it's a holding company that, gets involved in the management and tries to improve the companies. And they got Microphase here in 2017. And then you can see kind of the older tech and defense companies that they hold. And then here is Microphase Corporation. And so they do photons. They do radio waves and microwaves, like the lower energy waves, the longer frequency, communications for drones and towers and ships and missiles and stuff like that. And they do, amplifiers, oscillators, all the kind of wave detection and wave communication stuff. And so that's what the company does, and that's what they got is contracts for the next about a year's worth of contracts, which is good for Microphase. And Microphase, is only one holding of DPW. Let's take a look at DPW. So where are we on the hourly? So yeah, here's the news blast. And so, I mean, it jumped from $1 to $6, and it's already coming down. And let's take a longer look at DPW. So DPW Holdings, they've had a couple of major reverse splits. This is a 1 to 40, a 1 to 20. And so they've had a long-term floor of around 400. And this company, it's like 50 years old. I think it's 1969. And they've had a couple of blasts up, 4,000 or higher. But largely they've been kind of wobbling around, 400 to 1,000 kind of range for a lot of years. But as of 2018, I mean, they just crashed from 4,000 down to pennies, basically, with the reverse splits here. It's trading at about $4. And so this is a really, really big kind of crash over the last few years for this company. And then we can get in tighter on this trading here. And so they've been trading around $1 for the last little while here. And they have a floor kind of above $1. Yeah, so this downward movement in the momentum has sort of looks like it may have bottomed or flattened out at least. And they've had kind of, a little news blast on a higher floor and a little news blast on a higher floor. Now that this is a big news blast here. And so I would expect probably a higher floor, and this is not investment advice, but maybe 2 something. Who knows? 233, that sounds good. Just kind of for a higher floor to land on here. And usually on these news blasts, you'll see it pop up the day of the blast, and then a lot of times same day it'll come back down and kind of settle on a new floor, and then just do normal trading activity after that. So that's the most likely scenario, I think. Sometimes you get kind of a second peak, on the second day, and then it'll kind of settle out over the next few days. But that's what I would expect is it probably will reverse back down onto this kind of area somewhere around here. Just kind of based on the averages, and it looks like it's been building up slightly. It's not like crashing with every news blast. So yeah, who knows? This might be a value stock. I haven't looked into all of their companies' balance sheets or anything like that. Just the news and kind of the trading action for what that looks like, and then we can jump over to the general market and see what's going on. And this has been a super slow week for news. We're just kind of waiting on J-Powell to come out and tell us whether or not he's going to print crazy money. And let me get out to let's get out to like the daily chart here. Yeah, so we just have a few days. This week is just kind of chilling right here. All right, so let's take a look at the bubble model and then talk about fundamentals and some liquidity, and then we can do like the technical analysis stuff real quick. So basically, this is a two-year tangent line of this bull market wave just the last 2 years up to this blow off top. And what we had here is we had a little back test, and then we had a swing and a back test. And so I thought that we were going into a bear market, and we had terminated this line, never to see it again. And now we've swung all the way back up to this line again and tested it. And so this is a critical spot here. And this timeline is, I mean, a few months, that's a more normal timeline for kind of testing the backside of a bubble on a tangent line rather than just immediately breaking it, I suppose. But we came so far down here, it looked like we were off of that line, but we're not. We're back on it. And so I guess from the bubble model perspective, what you'd be looking for on the backside of a bubble is you back test and then you swing and then you back test the thing again. A lot of times you get a double test, and then you break down below the next tangent line and back test that one, and then do a big swing out. So potentially from here, you'd be looking for maybe like a double test of this one, and then break this one and back test it, and then kind of do a swing out. And who knows, that could be like a year's worth of a swing out. But as far as unwinding the bubble in a bear case, a long-term bear market case would be to actually backtest this line and terminate it, and then you get below the next line, and then work on that one for a while until you terminate that one. And so that's kind of the bear market case. And then for the bull market case, we have this line here, and as of now, we have just gotten rejected underneath it. But what the bulls would want to do is this is the line that we've been operating on the bull side here, and so that's what I would look for on the bullish, would be to just get above this guy and probably a little bubble-ish moves, but then just use this as a longer term bull market support like we were doing previously, and then there's not really any time limit on that. Just kind of use that as a bull market line in the bull case. And so that's kind of the bubble model, where we are on this tangent line. Are we going to terminate this tangent and get off of it down, or are we going to use this long term as a bull support line again? And so that's kind of the look now. And this is just sort of a rough, a rough bull support line here. That it looked like we broke here, and it looked like we broke this support line and this one. It looked like we were going to break down, and we got above both of them and ran up. And so, yeah, we're up here now, and this is really interesting. This is not something that you'd commonly see on the backside of a bubble, where you break two different support lines and then get all the way back up to this one. Usually you will react along one line. Longer than that, usually you'd react along one line, and then you'll break down under the next one, then you react along that one, and then you break down. That's what you usually see on the backside of a bubble, one line at a time. Break it, back test it, swing, test it, then you break down to the next line, back test it, kind of swing out, that kind of behavior. But yeah, this is a hell of a sell-off and a hell of a rebound. This is wild. So I mean, if we got kind of a swing like here, that would be reasonable and normal. But this is a crazy, insane sell-off and rebound. This is absolutely crazy. So that's kind of a look at the bubble model right now, where we are, and all eyes on this, Volmageddon tangent line right now. That's where we are. And then on the I guess on the general fundamentals, of course, like price to earnings is all awful and stuff like that. And half the economy is shut down, and there's a bunch of companies that are facing insolvency right now, and they're already unprofitable, and now they can't get more loans. And so there's a big swing on the fundamental side, I mean, we've had buybacks increasing over the last, whatever, 10 years or something. And as of this crash, the buybacks have decreased dramatically. And there's still some buybacks in the infotech sector, but the buybacks in every other sector have almost completely dried up. And now it's switching from buybacks where there's less shares and higher stock valuations to companies issuing more shares and trying to get enough cash to stay solvent, to just be able to pay on their debt. And so when companies start issuing more shares, that's diluting the shares, and that's not good for stocks in general. And then as far as the liquidity goes, like this down move was a huge liquidity squeeze. Not so much in America, but the rest of the world had a huge liquidity squeeze where basically the international banking system just kind of froze up, and there wasn't enough dollars for people to service their loans all across the world. And so the Fed, like really, really fast, set up all of these four-letter word programs and set up swap lines in all the friendly countries where they wanted to help, and then didn't set up swap lines in the countries that they're trying to lean on, and basically fix the dollar squeeze in a matter of like a month and a half. And so to look at the liquidity, so basically the Fed just blew the balance sheet up like crazy and just pumped money all over the world and sort of reconnected the entire international monetary system, the whole Eurodollar system here. And now the Fed has been sort of decreasing, not decreasing the balance sheet, but decreasing the amount that they're increasing the balance sheet, just sort of tapering it down a little bit. But what started happening during this swing here, though, is the Treasury now has started issuing more and more Treasury bonds, and they created an entirely new series of 20-year Treasury bonds the last couple of weeks, and the Treasury bond issuance has gone like 4x, and looks like it's continuing to increase. And so this is like the Stan Druckenmiller look at available liquidity, which is like the Fed balance sheet is liquidity, yeah, but you have to also look at Treasury issuance. So, I mean, if the Fed is creating 80 billion a week and the Treasury is issuing 80 billion of Treasuries, that's like a net zero for available liquidity, because the Treasuries are going to take liquidity out of the market for government spending. And so that's kind of the transition here that we're looking at, where we got a mess of liquidity from the Fed here, and now it's transitioning into decreasing liquidity as the Treasury issues more and more, Treasury bonds. And so it looks like we're getting a swing from buybacks to actual new stock issuance, and it looks like we're getting a swing from Fed liquidity to Treasury bond less liquidity on the fundamental side right here. And it looks like the majority of the liquidity is not coming from FOMO buyers, like maybe the price action a little bit, but the actual volume of liquidity is international, because this is a flood of liquidity into the international banking system. And so as all the other countries go to negative rates and their markets and their treasuries for all the other countries look worse and worse, it should be looking better for dollars. And so we got this huge move up. But just now, we just got a steepening yield curve. So other countries have started selling off U.S. treasuries, and the U.S. is issuing more treasuries. And so we're getting kind of a switch in the liquidity fundamentals right now. And it's pretty interesting right here on this trend line. But that's kind of the outlook today, and we want to see what the Fed says, if they actually tell us what they're going to do or not, or if you believe them. But basically, if the Fed says like, stuff looks okay right now and we don't need to do a whole bunch more money printing, then that means that all of these new Treasury issuances are going to drag liquidity out of the market. But if the Fed says like, oh, the Treasury is issuing all these new bonds, so we need to pump a bunch more liquidity for the bonds, then you could see a continuation of the same kind of liquidity. That's kind of what I'm going to be looking for, to see what the Fed says and see if they mention treasuries or not. See, I mean, last time they just said like they have the ability to print and support the monetary system. Like, okay, it doesn't say what you're actually doing. And they said, there's risk in the market. Like, okay, so you just basically said that you're the Fed and the market is the market. Like, that's not that useful. Like, I want to know if they're actually printing more money to offset the treasuries or not, and the actual liquidity that's available. And it's not like you get to see where it's going anyway. Like, even Congress is not allowed to see where the Fed is pumping the money. But it's pretty obvious that they've just been like bailing out the entire euro dollar system. They've just been pumping into all the international banks. Um, and so with the dollar, yeah, let's take a look at some stuff here. So let's see if the DXY is breaking down more today. So yeah, the DXY has done a big breakdown. Yeah, it's still breaking down. Okay, so this is the USA liquidity being more than other countries' liquidity, mostly the euro, because the DXY is a basket, but the euro is the biggest one in the basket. So as this breaks down, that means that there is more US liquidity than other countries. And so here, I mean, when the Fed did this initial blast of liquidity, the other countries responded really hard, like even more than the Fed on a percentage basis. Because like the US dollar is like 70% of the world money and the world loans. And so like when the Fed creates US dollars, it's relative to that 70%. Whereas like whatever, Brazil, if they print a little bit of money, it's relative to their tiny slice of the pie. And so each country basically has the ability to inflate against the dollar if they want to. And there's no way for the dollar to really keep up if the other countries want to inflate. But yeah, but this is the big inflation deflation scenario where if the other countries want to sell their commodities, they want to inflate their currency to decrease their debt burden and decrease their commodity prices so that they can compete and sell their commodities. That's sort of the deflationary scenario. But right now we're getting an inflationary scenario where the dollar's actually coming down. And so this is the really important thing to watch now is if inflation continues in the dollar, will it run away, and what happens to the interest rates? Because we just got the steepening yield curve, and the U.S. never went negative, so it's near zero on the short-term Treasury bonds, and then it's up to about I think it was 1.68 or something on the 30 years, and so it's a steep curve from zero up to 1.68. As you go to the 3-month and the 2-year, the 5-year, 10. Now they have 20 years that they just issued in 30s. And so it's, well, this way. Yield curve is steep now, and that steepening yield curve generally indicates that you're entering a recession. When you go from a flatter or an inverted yield curve into a steeper one, that's a recession indicator, which not that we need a recession indicator. It's pretty obvious. Like the whole world is in a depression and America is at least in a recession. But the dollar is the reserve currency, so America can print the reserve currency. It puts the U.S. dollar in an interesting position, and yeah, I don't know how weak the Fed would actually want the dollar to get. Like they want positive interest rates, a little bit positive, and they want a little bit of inflation. But if it started getting away from them, I mean, if the interest rates go up much more than where they are now, then that would be an entirely different set of problems. Like right now, they're trying to fight against deflation and the contraction in the monetary system. And if this keeps breaking down, now they'll have to try to fight against inflation and completely different scenario. And other than the dollar coming down a little bit, and this is not way out of range, like this is still in the similar range where we've been. So this is not like a hyperinflation scenario just because the DXY came down a little bit. But I mean, if it came way down, it would be. And if the interest rates start going way up, it would be. But just looking at silver is just kind of chilling. or that's physical gold, sorry. This is the silver one. But silver's just kind of chilling where it is. Gold's just kind of chilling. Like we're not getting big indicators. Um, yeah, the VIX is an interesting one. So the S&P is just sitting there, not doing much, and the VIX has been going up pretty dramatically from 24 to 29 or something over the last couple of days. So that's weird for the VIX to be kind of blowing up when there's not a crash happening. But if you look through kind of like the XLF, like the financials have kind of looped and turned over a little bit, and the small cap stocks have kind of looped and turned over a little bit. And so those are sectors, well, that are not doing buybacks for one, and they have way more exposure to low interest rates and to insolvency risks. And so I think that the small caps and the financials have the most bear market risks right now, just because of the exposure to the debt, and then the low interest rates are terrible for the financials. It's really hard for the banks to make money with those interest rates. It's just kind of high risk and no reward for the banks, and that's kind of been the case for since 2008. The banks have not been doing very well. So that's kind of a look at the market, and please hit the subscribe button. I'm trying to get to 1,000 channels, still pretty new. But yeah, I guess that's it for now. This video is not special for any kind of playlist, but if you want to take a look at financial education videos, you can go check out my playlists. And let's check out the puts to calls. I heard like the last couple of days, we had a record number of calls, kind of on the tail end of that huge, parabolic run up. And usually like a couple million calls is a lot. And there was something like 12 million call options that were opened over the last couple of days. And so now we've got some more shorts coming into the market today, which is interesting. The VIX is going up. The shorts are coming back in a little bit. But yeah, just the FOMO and the parabolic move and all that stuff, like 12 million something call options is just absolutely nuts. And yeah, all right, that's probably pretty good. What's the oil volatility look like? Yeah, oil volatility just kind of chilling. It's filled this gap here, and so, man, oil. I really liked oil until it made such an aggressive move up now that I don't know what to think about it. Like I wanted to go long on oil over the next like 2 or 3 months or something like that, but now it's already up at the price targets, and I don't know. I don't know what to think about the oil situation. The volatility is still high. It's still a risky oil market here. And then what do we have? Oh, Russell volatility. Oh, right. Yeah, so the volatility on the Russell is up near like 40. Like this is still really dangerous volatility, way more than the S&P, the Russell volatility. So these are the small caps. So that's just kind of a look at which sectors kind of have the most dangerous exposure to the insolvency risks and the low interest rates. And we'll have to just see if inflation continues and which direction these interest rates head. So if the interest rates lower, if it stays steep but they lower, then that would be the longer term recession kind of indicator. Or I mean, if they start going up, if interest rates start climbing, then that's like a high inflation indicator. And so I think almost everybody is expecting one scenario or the other, like a major problem one way or the other. Whereas you get like a high inflation, hyperinflation scare, if the interest rates are going up and inflation's going way up, or you get the negative interest rates where other countries are inflating their currencies aggressively against the dollar. You get a dollar that's way too strong. You get commodity prices actually dropping against other currencies that are dropping, and then you get the sort of depression scenario, which is deflationary on the worldwide kind of outlook. But right now we don't have really either one. Like the dollar's come down a little bit, interest rates haven't gone negative, and the Fed's probably going to give themselves a pat on the back. I think that's what they're going to say when they come out. They're just like, yeah, the interest rates are perfect. We fixed everything. The yield curve's beautiful. Like that's what they'll say. And it does look okay. It looks just fine actually for right now. Like they kept them positive and they got it steeper, and that's what you want when you're coming out of a recession. And it could stay steep for who knows. I mean, it was steep for like 8 years or something after 2008, and that was a really long, slow recovery. Um, but that's not where I think we are at all. Like I don't think that we're recovering out of this thing right now, because the VIX is still nutty, and I mean this is the biggest rip like in the history of the stock market. Like I don't think you just forget about this thing. Like it was just a little liquidity squeeze, no worries, and then just go back to what you did. I mean, we'll have to see what happens, but I still expect this to be a bear market scenario. And the fundamentals are, yeah, the fundamentals of the liquidity is really interesting. If we get a different kind of liquidity squeeze right now, based on treasuries, because this liquidity squeeze was the international banks not being able to function properly, and now we could get a liquidity kind of squeeze from the U.S. Treasury having to kind of prop up the economy on the fiscal side. And so, yeah, if we get kind of runaway bond issuance, that's a different kind of liquidity squeeze that is possible here. And pretty easy for the Fed to create liquidity for the Treasury. Like that would take them like 10 minutes to fix as soon as they want to do it. Unlike this thing, which was like they had to restructure the entire financial system and reconnect all the international banking stuff. And, this is a crazy restructuring of the whole dollar system, where the Fed and the Treasury are more connected, and it's more of like a central bank to the entire world system. Whereas before, the Fed was just doing domestic U.S. dollars, and all the international banks were doing all the international loans, and it was almost like 50-50, where the half of the dollars are U.S. dollars and the other half of the dollars are out in the rest of the world. And now it's sort of reconnected, but it's complicated. It's a complicated mess right now. But it is more like the Treasury is sort of leading the Fed and is actually more central to the international dollar. It's more of a central banking international dollar. In just a few months now, we basically have a central banking international dollar instead of a bank issued, uh, dollar. It's like a different kind of dollar, and those dynamics are not clear. And definitely watching the bond rates and the interest rates over the next couple of weeks, and watching this yellow line right here. That's what's happening. That's what's happening this week. Is this yellow line? Is this going to be a bearish rejection off of this thing? Are we going to terminate it, or do we get on top of this thing and actually use it as a bull market support line for the foreseeable future? That is the outlook, and this is not investment advice. And happy trading.